So my name's Dan Bowman. I'm the president of the bank. Most of you know me. I'm going to serve as chairman for this meeting. And so let's kick it off. I'll serve as chairman. Jeanette Young, our corporate secretary, will serve as secretary of this meeting. The agenda tonight is to elect the board of directors, which we do every year, ratify the appointment of our financial auditors, Ide Bailey, report on the activities of the bank, things that we're working on, things that we've accomplished, etc., and then conduct any other business that comes before us, and then answer any questions you might have. And feel free to ask all those uncomfortable questions or whatever. I don't know. Or maybe don't feel free if it's too... Well, we start off our meetings with prayer. And our shareholders meeting is the same. Now, Bernie Wolfswinkel, many of you know Bernie. Bernie is getting along in years. He is, I don't think he'll be upset if I say he'll be 93 this year. Wow. And Bernie continues to be our chairman of the board, and he's doing a fine job. He's a great guy. It's hard for him to get out, so he couldn't be with us tonight, but he pre-recorded a prayer for tonight's event. So with that, if you bow your heads, let's have Bernie's prayer.
Our gracious Heavenly Father, I want to come to you again this evening. Thank you, Father, for everything that you've done for the bank. I want to thank you, Father, for the man that we have in charge, and the President, Dan. He does such a good job of hiring the employees. I think we have the best employees in the world, and I want to thank every one of them tonight for being there and doing the work that you do for us. Now, Father, as we get ready for this meeting, I want to thank you for the food that was able to have. We are so spoiled, Father, in this country where we have such an abundance of food. Now be with all the people that are in attendance tonight, and we just hope and pray, Father, that everything that is said and done may meet with thy accordance. And we ask this all in thy most precious name, our dear Lord and Savior, Jesus Christ. Amen.
Amen. All right. Thank you, Bernie. Dave, could you give me a water? So, next item on our agenda is the flag salute. Roger, would you mind?
Shall we all stand? I pledge allegiance
to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Thank you. Thank you, Dave. Another thing that we do many years, almost every year, Bernie used to sing God Bless America. Now Gigi has taken up the mantle of singing God Bless America. Bernie has got a real fast cadence, and he would be, I don't know, 2 or 3 lines ahead of me. But with that, Gigi. All right.
Test.
There
okay. We go. If you could all sing with me, I would very much appreciate it because I'm very shy.
Yeah, right.
And this is for Bernie. God bless America, land that I love. Stand beside her and guide her through the night with the light from above. From the mountains to the prairies, to the oceans white with foam. God bless America, my home, sweet home. God bless America, my home, sweet home.
Thank you. Thank you. Oh, what else have we got? So, I don't know if they're on the tables or on the chairs or where they are, but we've got a contact card, and we'd like to be able to have all of our shareholders' contact information. I don't know how to turn this darn thing off. Oh well, let Josh take her on. Because, we change. We get different cell phones, we change phone numbers, we change email addresses, that sort of thing. So we want to be able to update our records so that we can send you information and contact you, that sort of thing. So contact cards are out there. And at the end of this evening, we're going to put all the contact cards that get filled out and turned in. We're going to put it in the tumbler back there, and we're going to pull it out. And the gift or the basket for tonight's winner is a safe. Stuff full of cash. No. Yeah, it's right there. It's the vault. No. So, of course, the safe, Chino Commercial Bank hat, Rancho Cucamonga Quakes hat, Rancho Cucamonga Quakes Clear Stadium tote bag, a Dalton Rushing bobblehead. You can put that in the back of your car. A Tremor bobblehead. I guess you can put them both in the back of your car. 4 tickets to any 2024 home game. Rancho Cucamonga Quakes jersey, snacks for the game, and CCB swag. So I'm not sure exactly what swag is. Actually, I do know what it is. It's it's pigs and stress pigs and that kind of thing. So anyway, that is our raffle prize this evening. So don't forget your contact card. In terms of introducing our board of directors, Richard Malooly is our vice chair. You met Bernie, of course, our chairman. Richard Malooly is our vice chair. And Richard, where are you? Right here. There you are. You're hiding on me again. Linda Cooper, president of Inland Empire Escrow. Linda, where are you? There you are. Okay. Yeah. Jeanette Young, 2 doors down from Linda. And Julio Cardenas. Julio, excellent. Tom Woodbury, I think I saw Tom coming in. There he is. Hello, Tom. Ken McElvaney. Ken. There's Ken. All right. Joe is pointing at Ken. That works. And Roger Caberto. Many of you know Roger. He was our chief credit officer for, 20 some odd years. And, after 20 years, he goes and retires. What a flake. No. Actually, he's still very actively involved. He's the chairman of the Directors Loan Committee. And it's really kind of fun because we'll talk about a particular loan that Roger may have worked on 15 years ago, and he still remembers details about the deal. Is that guy still over on this place and he's still doing that? It's amazing. And of course, I respond by saying, "Who are you?" No. And I would love to take the time to introduce our entire staff, but we have got a lot of staff these days, and that would take us till tomorrow morning to do all that. So at any rate, we've got, as Bernie said, we've got a great staff. And that's where the success comes from. So not joining us in person tonight, but joining us virtually will be our partner from Eide Bailey, our financial auditing firm. In addition to that, our legal counsel, Stuart Moore and Staub. Ken Moore is our attorney, and Mike Staub does work also. And Hilltop Securities, you may know Mike Natzik in Big Bear. Mike makes a market in our stock. So they are joining us virtually, but not in person. Kind of nice we can do that. So this meeting is part of the resolution, or the call resolution, by the board of directors, and the proxy statement and proxy solicitation that hopefully you got at home with your annual report. And we have a sufficient number of votes to hold this meeting. So with that, I'd like to call up Carol Murdahl and Julio Cardenas. Carol was the bank's human resource director for 15 or 18 or 19, I don't know, a lot of years. 16 years, long time. I had hair back then. She has retired. It's a reoccurring theme these days, people retiring. But so Carol is retired, but she's still here, and she is helping us with something I'll talk about a little bit later. So with that, Julio and Carol, thank you.
Good evening. This meeting is being held pursuant to the call of the Board of Directors and the legal notice of the annual meeting dated April 16th of 2024. May I hear a motion to waive the reading of the legal notice and to attach the secretary's certificate to the minutes of this meeting? Do I have a second? It has been moved and seconded that the reading of the legal notice be waived and that the secretary's certificate be annexed to the minutes of this meeting. All in favor of this motion signify by saying aye. All those opposed signify by saying nay. The motion is carried. Where's that? Oh, that's right. Thank you, Carol. See? Sheesh. May I hear a motion to waive the reading of the minutes of the last annual shareholders meeting? May I please have a second to that motion? It has been moved and is seconded that the reading of the minutes of the last shareholders meeting be waived. All in favor of this motion signify by saying aye. All opposed signify by saying nay. The motion is carried. A certificate of mailing showing that the notice of the annual meeting and proxy statement were properly mailed has been filed and will be annexed to the minutes of this meeting. The board has appointed Carol Murdahl to serve as the inspector of election to count the votes, determine the validity of proxies, and decide on all questions and challenges arising in connection with the election. Will the inspector of election now give the quorum report?
Of the 3,211,970 shares of the company's company stock outstanding as of March 26, 2024, the record date for this meeting, 2,168,785 shares, or 67.52%, are represented either in proxy or in person.
Thank you, Ms. Murdahl. Since 1,605,985 shares are necessary for a quorum, and 2,168,785 are represented, a quorum is present. Therefore, this meeting is duly organized and can proceed with conducting business. As you know, there are two legal actions to be taken in this evening's annual meeting of shareholders. One, the election of the company's board of directors, and two, the ratification of appointment of independent auditors. Since the company has not received any notices of intention to nominate directors pursuant to the company's bylaws, cumulative voting will not be necessary. Therefore, we will dispense with any explanation of cumulative. I would like to announce the following 9 candidates that have been nominated for election to the board of directors to serve until the next annual meeting of shareholders and until their successors are elected and have qualified. Dan H. Bowman, Roger Caberto, Julio Cardenas, Linda M. Cooper, Richard G. Malooly, Kenneth McIlvaney, Bernard J. Wolfswinkel, Thomas A. Woodbury, D.O., Jeanette L. Young. I would like to entertain a motion to elect management's slate of director nominees. Do I have such a motion? May I please have a second to that motion? All in favor of this motion signify by saying aye. All opposed signify by saying nay. The motion has been carried by voice vote. As you probably know, your proxy card gives you the ability to vote against individual candidates, in addition to being able to vote in favor of or against the whole slate of nominees. As a result, different nominees have different numbers of votes. Now I would like to call on the inspector again for the official result of the voting. Ms. Murdahl, could you please tell me the least number of shares voted, authority given, with respect to any of the nominees for director?
1,788,880.
And the total number voted, authority withheld?
16,258.
Thank you. Management's 9 candidates have officially been re-elected to serve as directors for another year. The second item of business is the ratification of appointment of independent auditors. As indicated in the proxy statement, the proposal is not legally required, but the board has chosen to voluntarily give the shareholders the opportunity to ratify or not ratify the audit committee's appointment of the independent auditors for the upcoming year. The audit committee still has to be the body that makes the ultimate decision about the selection of the company's independent auditors, but is interested in the opinion of the shareholders concerning its decision. May I have a motion to ratify the appointment of Eide Bailey LLP as the company's independent auditors for 2024? May I have a second to that motion? All in favor of this motion signify by saying aye. All those opposed signify by saying nay. The motion has been carried by voice vote. Now I would like to call on the inspector again for the official results of the voting. Ms. Murdahl, can you tell me the number of shares voted for and against this proposal?
There were 2,167,240 for the proposal and 1 against.
And the number abstaining?
1,544.
And can you also tell me the percentage of the shares represented and voting that were voted in favor of this proposal?
The percentage of shares voting in favor of the proposal was 67.47%.
Thank you. This proposal has been approved. Will the Inspector of Election please file your certificate of voting results when completed with the Secretary? That concludes the formal business portion of the meeting. I would now like to call on Dan Bowman for his presentation about the 2023 operating results and future plans. Thank you.
These guys, you know, they do a great job every year. Thank you. That's terrific. And before I forget, and I will, let's take a minute and just appreciate the staff and all the hard work everyone has done. You know, truly, I did it all. No, actually, they have gotten to be so good. They say, "Gee, Dan, why don't you go get a coffee? Come back later." No, it's good. This is our 4th year here in the building. When COVID hit, we couldn't meet at Los Serranos Country Club anymore. And we said, all right, let's meet here in the branch. Let's see how that goes. And it worked so well, and it was nice, and it was paid for, and we said, all right, let's do that again. And so here we are again for the fourth time. Fortunately, we've kind of figured out some of the bugs, online voting and all that sort of thing, and it's got to be easier. So anyway, well, let's jump into it. 2024 economic outlook. That's an easy one. Everything is terrible. Any questions? Yes. Well, or so you would believe if you listen to CNN and MSNBC and Fox News and everybody in between. There's always something to be anxious and upset and worried about. And I think it's important for us to keep in mind that these news feeds are in the business of kind of selling fear, or that's an instrument that they use in order to increase viewership and clicks, and they're paid by clicks. And if I'm more anxious about something, I'm more inclined to go on and look at it more and look at it more and look at it more. But I think it has a negative effect on our outlook of life. And so, and by the way, as I talk about the economy and what's going on, there's a tendency, and in fact, one time I was giving a presentation, and I was just talking about the economy, and somebody said, well, are you whoever the president was at the time? It's not our current group, but it was somebody else. And I said, are you that guy fan? And I'm not an anybody fan. I'm just giving the numbers. So, but if I talk, the economy's good, somebody's going to say, well, I think he likes Biden. Or if the economy's bad, I think he likes the other guy. I don't like either one. The truth is, there have been 45 presidents since 1789. A lot of folks have come and gone through that particular office. And as you plot the economic numbers, they didn't change dramatically. I mean, you can't look at it and say, oh, that's when Fred was the president. Everything was terrible. Fred seems to do well in good times and bad times. And the truth is, most of us, we get up in the morning and we take a shower, and we thank God we take a shower, and we go to work and we work hard, not because who's in office, not because it's the blue team or the red team. We do that to provide for our families and take good care of our customers and do good work, and our heart and our minds are engaged in it, not because who's in the White House and that sort of thing. And that's where the strength of the economy comes, is from people working hard and doing just that. So anyway, I just throw that out because somebody may want to read into some of my numbers as though I like one particular guy more than another guy. Well, it's a good thing for the whole world. I'm not president for a week. I'd fire them all. But anyway. So let's first start off looking at GDP. Now, that stands for Gross Domestic Product. Now, gross domestic product just means the sum total of all of the products, the services, the widgets, the what have you, the total sale of everything domestically. Add it all up, that's GDP. And in fact, what a recession is a decline in GDP. So, okay, how does it look? Well, shoot, it's at an all-time high. In fact, it's growing pretty fast. All right, that's a big number, but GDP, gross GDP, doesn't look at inflation. So, if I had sales of 100 before, but the price of my product went up, and now I'm selling at 120, you'd say, well, gee, I'm selling more. Maybe I'm selling the same number, I'm just selling them at a higher price. So you inflation adjust, or you look at what's called real GDP, or inflation adjusted GDP, and it's at an all-time high too. All right, well then, gosh, it isn't inflation, it must be real economic activity that's driving this. All right. How about retail sales? And by the way, I'm like everybody else. I look these things up, I read them and go, I didn't know that. That was interesting. I would have bet you a quarter retail sales was off. And in fact, it's not. As we can see here, it came back in a hurry following the great pandemic because everybody had pockets full of cash, fresh from the government. But, and this goes all the way back to, I think it's 1990. If we zero in and look at this same chart over 2 years, you can see that in December of last year there was a dip, but beyond that, it's really growing in a pretty healthy way. And in fact, today is the highest level we've seen on retail sales. So, okay, all right. How about unemployment? That's bound to be terrible. Well, all right, 3.9% is higher. It was as low as 3.4. But to keep this in context, back when I had hair and was going to school, the economic wisdom of the time was that in a modern economy, turnover amongst employees is such that you're going to get a floor of about 5.2%. That, even full employment will be around 5.2%. Well, apparently that theory was wrong because we're at 3.9. Now, if we apply a line across this, horizontally, again, going back, that's 1945. Unemployment was higher than this most of that whole period. So, all right, unemployment isn't catastrophic. It's up a little bit from a low point, but it's really pretty good from a historical level. Consumer Price Index, and this is the one everybody loves, core Consumer Price Index. Now, core means you take out food and fuel because they're more volatile. And, everybody immediately says, yeah, I try to live without food and fuel. And I completely agree. But the Federal Reserve likes this metric, and so, all right, let's pay attention to it. Why do they like it? Well, core CPI in the most recent period at 4.5%. Okay, all right, that's pretty good. Well, let me rephrase that. When we talk about consumer price index, what we're talking about is inflation, okay? So core hit 6.45%. All right, it was in the news. Now, raw headline inflation is what it's referred to, went as high as 9.4. But again, core is the metric that Jerome Powell likes. So core peaked at 6.45. Today, it's down to 4.5. So it's about 200 basis points below where it peaked. Now, the Federal Reserve has stated a target for inflation at about 2.5%, or core inflation at about 2.5%. So there's still another 2% or 200 basis points to go. We're not there yet. All right. But if we look at the 4.5 across the spectrum of going back to about 1967, for a fair amount of that time, inflation was higher than it currently is at 4.5. Now, I'm not saying it's good or it's okay or we should learn to live with it. In my opinion, any inflation is too much. But it's not like we're going over the cliff, as some would suggest. 30-year fixed rate mortgage, 7.02. We've got a lot of folks here in the real estate industry, and that's where the rubber really meets the road when you're trying to qualify for a mortgage. Most especially when not that long ago it was 2.7%, something like that. And unfortunately, when you finance a house at 2.7%, you can finance a lot more, and it tended to drive prices up. And the conclusion was when mortgage rates go up, prices of housing will come down to adjust. And mathematically, that would be true. But as we'll see in a minute, it's not happening yet anyway. So 30-year fixed rate residential mortgages, and again, all this information comes from the Federal Reserve out of St. Louis. So the average nationwide 30-year fixed rate mortgage, 7.76 is where it peaked out. Today we're at 7.02. All right, well, that feels high, most especially in the context of 2.7. But keep in mind, I'm old. I was looking at a car the other day, and the car was $135,000. Are you out of your mind? That's when I say, my first house was $11,000. That's what old guys do. My grandfather used to tell me, a sack of potatoes cost a nickel, but nobody had a nickel, so it didn't matter. But if we look at this same chart going all the way back to, I think it's 67, and we run this horizontally across, we can see that 30-year fixed rate mortgages have been higher than 7.02 for a number of years. And in fact, If you go back to 2000, the year we started the bank, 30-year fixed rate mortgages were higher than that. And we still got by. We still did fine. You've got to be a little more innovative. You've got to try to adjust for things, and I'm not minimizing it or saying it's not important. It is important, but it doesn't mean we're all going to die by Friday either. If we look at the Case-Shiller Home Price Index, now that is a survey of all home prices across the country. And the thing is, you've got Arkansas and Beverly Hills in the same thing. And if you start to get more local studies, they change quite a bit, but the average blended rate between Arkansas and Beverly Hills, or probably more like Chino Hills, is $312,000, an all-time high. So at a time we would have expected real estate prices to begin to decrease. The Case-Shiller Index is at an all-time high. And anecdotally, as you talk to agents with listings, we're getting backup offers and over list price offers and that sort of thing. So there's good demand for well-priced product. Okay. Residential mortgage delinquency. Now this is one of those that when I did the research, I was surprised. I anticipated residential mortgage delinquency to be higher because after all, it's terrible, right? It's not 2.7% average or total mortgage delinquency. And as you can see, going back, now this goes to 2012, on a relative context, it's really a pretty low number. And similarly, credit card delinquency, I expected that one to be a lot higher, 3.1% nationally. And again, if we take a horizontal line on this, we can see that for a whole lot of the time of going back in history, delinquency on credit card was higher than it is today. Okay. Total consumer credit. Now this one doesn't surprise me. 5.1 trillion, all-time high. All right, we're first in debt. I can't really explain that one other than to conclude that a car now costs $135,000, and so that's a pretty big car loan. Back when I bought my first house, it wasn't $135,000. And this is interesting. Now, this particular chart is looking at household debt service payments. So total loan payments for a household as a percentage of discretionary income. On average, 9.7%. That's a particularly low number. Intuitively, I thought it was 99%. In fact, after watching the news, it was 199%. But fairly low. And that may shed some light on the low delinquency, both on credit card as well as residential mortgage. Now, one thing that's talked about a lot, and if we run this 9.7 back, we can see that's a pretty low basis. And it looks as though during the pandemic, when there was a lot of stimulative support going out, folks paid down debt, or at least structured payments better. Okay. Commercial real estate delinquency. Now that's one there's a lot of talk about. An expectation is that commercial real estate, foreclosures, delinquency, loss are increasing and that we've got a problem. And I think we've all driven by various strip centers and seen the for lease signs and that sort of thing. That gets your attention. It's kind of obvious, especially if we have 2 or 3 signs on the same property. Okay, fine. Well, in a case like that, the tenant has vacated, but the property owner still continues to service the debt, to make his payments. Now, he's trying to find a new tenant to put in there in order to cover those payments, but it's not going delinquent. So commercial real estate at 1.7%, very low number. And then finally, properties in foreclosure. It's just about 100,000. Now, the blue box there represents the Great Recession, and we were up at about 1 million properties in foreclosure. Today, it's right at about 100,000, so 10% of where we were at that time. So pretty good numbers. And, you know, one thing you don't see very much on the news feeds is anything about gratitude or optimism or encouragement or, good stuff. And I think we have to be careful on this. I know myself, I can get caught up on this like everybody does. And, oh my God, what are they doing now? Beating up somebody. And anyway, so interest rates. You hear things like, are they going to drop interest rates? Well, okay. As though Jerome Powell is the great interest rate genie, and he's going to blink and interest rates are going to drop. Well, okay. Some of that may be kind of true, but keep in mind, interest rates are a reflection of the average inflation rate, and then you add to that a margin for risk, either risk because of credit or risk because of duration or risk for different things. So interest rates are driven by the environment we're in. And would it be possible that the Federal Reserve could drop the Fed funds rate down to zero? The answer is yes, they could. But that would become highly stimulative. So think about it this way. If I can buy an asset that is increasing in value at about 4.4%, and I can finance that at anything less than 4.4%, I'm going to do more of it because I capitalize on the debt. And that's exactly what the Federal Reserve did for quite a while. Remember, the Fed funds rate for many years was at 15 basis points. It was super low. And the 10-year was at 1.58. But yet we had a 2.5% inflation rate at the time. And what we saw was increase in asset values. So interest rates aren't just a matter of divine proxy by the Federal Reserve, they're reflective of inflation. So May of 22, so 2 years ago when we met, this is what the yield curve looked like. And hopefully everybody's kind of familiar with the yield curve. What this looks at is on the left-hand side is short-term Treasury rates. So that's the 1-month Treasury rate down at the far left-hand side. And at that time it was 58 bips, or 58 1/100ths of 1%. And then over toward your right is the 10-year, and the 10-year in this particular case, 2.76. So that's why that didn't work. I pushed the wrong button. And what we look at is the difference between the 1 month and the 10-year, or the 2-year and the 10-year. They're different metrics, but you're looking at short-term interest rates versus the 10-year interest rate tranche, and you're trying to determine the net interest spread between those two. And when we looked at this chart back in 22, the positive spread was 218 basis points, or 2.18%. Okay? And the relevance as a banker is we pay on deposits for overnight. We borrow from our customers in the form of deposits. In this particular case, we would pay 58 basis points, or 0.5%. And then we lend on the 10-year tranche, which 2.76, so that's about a 200 basis point gross spread. Pretty good. Now the following year in 23, the yield curve was negative. Now what that means is if I look at the 1 month versus the 10-year, it was a minus 1.92, or just about minus 2%. So how does that work? If I invest for 1 month, I get 5.59. If I invest for 10 years, I get 3.57 or less. What it tells you is that the economy is broken as relates to interest rates at that time. And what happens, or what happened here, is the Federal Reserve became concerned about inflation, as they properly did, and they drove up the short end of the yield curve. Keep in mind the Fed funds rate changes by policy statement. The Federal Reserve Open Market Committee meets, they resolve we're going to increase interest rates from here to here. They go out and they do an announcement on Wednesday and they say the new interest rate is X. And if that rate moves up faster than the long end of the curve, you get an inverted yield curve. And think of it kind of like hitting the brakes. and the inverted yield curve are the brake lights. That doesn't cause the recession. It just tells you that there's one on the way. And so that's where it was last year, and everybody's bracing for this crash landing of the economy, and it didn't happen, and it didn't happen, and it didn't happen. People like me are like, well, come on, we're supposed to crash here. Well, we didn't crash. If we look at the yield curve yesterday, that's the green one here, the 10-year tranche was at 442. So that was up 72 basis points from the previous year. And what we can see, the long end of the curve is driven by investors. And investors are saying, I need to get a higher rate of return or I'm not going to buy that treasury. The short end of the curve, that's by policy statement. The long end is by auctions. So on that particular date, 4.42 was the rate on the 10-year. But remember, core CPI was 4.4. So the difference between the 10-year treasury at 4.42 and core CPI at 440, that's only 2 basis points. That's not enough of a margin. And where I'm going on this is I'm anticipating if we look forward, we're going to see more pressure on the long end of the curve, meaning the 10-year side will continue to move higher. Now that'll affect things like mortgage rates. Mortgage rates won't drop. So it may seem a little counterintuitive. The Federal Reserve will come out, they'll do an announcement, they'll say we're going to drop rates from X to Y. Okay, good. And we all say, terrific, time to refinance. And then mortgage rates don't go down because it's the short end of the curve the Fed controls, not the long end. So it may become counterintuitive there for a little while. Now, last year we're at 3.67. The year before that we were at 2.76. The year before that we were at 1.58, which is improperly labeled as 2.76. Oh well, the magic of PowerPoint. So we've went 1.58, 276, 367, 4.42, and recently as high as just about 5% for a short period of time. So there is upward pressure on the long end of the curve. The downside of the curve, again, is policy statement. Now, the Federal Reserve in December, just after year end, was saying there could be as many as 6 interest rate adjustments in 2024. Well, that's not going to happen. We've run out of meetings since then. So we're not going to have 6 interest rate adjustments, but basically what that means is about 1.5 or 150 basis points. That'd take us from 5.5 to 4.0, but keep in mind CPI is 4.4. So that would drop below the inflation rate and would start to overheat the economy again. So I think that's why they backed off, and we're watching inflation. It looked like it was coming down, and then it bounced around, kind of went up a little bit. So looking forward over the next 12 months, I'm anticipating the long end of the curve will move higher. My projection here is 5.35. The short end of the curve will decrease, eventually getting down to about 4.0. Now, as a banker, this is a good thing because it's a positive curve. That's how we make money, is we pay less on deposits than we charge on loans, and the difference is how we pay the rent. So getting back to a positive yield curve is a good thing. So in summary, things are not as bad as they seem. The economy really is very strong. All the metrics are very strong. Now, I realize that a lot of folks on television and YouTube and what have you have a different opinion of things, but the metrics as I see them are pretty strong. Real estate values appear to be holding so far. Again, the Case-Shiller is at an all-time high, and anecdotally, we're seeing multiple offers on available properties. Yield curve is improving. The long end is increasing. The short end has promise of decreasing, if not yet. High cost of funds should begin to decrease. That cost of funds issue, that's what that means is how much banks pay on deposits. I'll show that in just a minute. That's a challenge for our industry. And credit quality so far, meaning loan quality, has been good. Borrowers have been able to make their payments. In other news, in 2023, the bank completed what's called a merchant service or an acquirer bank sponsor program with the card brands. So we have been offering merchant services or credit card acceptance for 3 years, but we did so as what's called an ISO, an independent sales organization. And another bank took the lead on that, and we offered it to our customers. The other bank did the settlements. They took all the money. We got the gratification of a job well done. So in 2023, we became members of the Card Association. That's Visa, MasterCard, Discover, and American Express. As members of the Card Association and as being a chartered bank, we can settle directly with them. And it's unique. You have to be a bank. You can't be a non-bank and do that. So, because we could, we joined the association and we moved away from the other bank sponsor and became our own sponsor. And what that did is, you know, you take $1 in this system and everybody takes a little bite out of it, and by the time you get down at the end, there's not much of the dollar left. In this case, as a sponsor bank, it goes directly from the card brand to the bank, and there's less hands in the process. So it's a good thing because we bank high net worth individuals and small businesses. Sometimes they're the same. And this is a product that they need. Folks don't spend cash as much as they used to. People like me walk around with no cash, and gotta use plastic. My favorite story is on the weekend, I walk around looking like a homeless person on the weekend. I got holy shirts and whatever. And I'm walking into the store, probably Home Depot, and this sweet little Girl Scout says, "Sir, would you like to buy some cookies?" I said, "Oh, honey, I'm sorry. I don't have any cash, you know." And that quick mom jumps up and says, "We take plastic." I bought cookies. So even the Girl Scouts are coming of age, and in fact, one of our first customers under this program was a Girl Scout troop. So anyway. Now this chart is showing merchant service revenue, and this goes back to 2021, January 2021. And for about the first 2/3 of that one, or a little bit more, it was under the ISO program. But then you can see at the end some of the impact of being a sponsor bank. And the revenue is significant. Today, we've got roughly 100 merchants, and all or almost all are our customers. Recent monthly revenue, and the most recent in the period that I looked at here, was $67,000 for 1 month in terms of total revenue. That's $804,000 a year in additional revenue. That's a meaningful thing. So in a time when interest rates on loans is getting compressed and our cost of funds is going up and we have what's called a narrowed net interest margin, this allows us the potential for a non-interest source of income. And it's helping our customers. In many cases, we can help save customers quite a bit of money. We've got one customer that we recently looked at, and it was part of a loan transaction, and so we offered it, and we offered a discount on it. I think his savings was $2,000 a month, below what he's currently paying. So, you know, he's delighted, and we're happy to get the business, and everybody's happy. So, at any rate, it is a great product. It's expandable. We truly have customers in Hawaii, and Chicago, and Dallas, and I don't know where else. It's a customer that has offices or stores in all of these locations, 18 of them, and we provide merchant services, and they do it all over the country. And so it would be difficult for us to provide direct banking services to a bank, let's say in Hawaii, for example. On the other hand, I can provide merchant services to somebody in Hawaii, so the expandability of this is significant. So far, I hope that's wood, operating losses have been 0, and that's something you need to be careful of. There's a lot of potential fraud and people always trying to do something, so operating losses so far have been 0. And at this rate, we're onboarding about 8 to 10 new merchants per month, sometimes a little more, sometimes a little less. That rate will be about 100 merchants at the end of the year, 12 months. And, back of the envelope math is if a current 100 gets you 800,000 a year, 200 should get you something close to twice that. Now, in the interest of full disclosure, we've got a whale customer in that, and in the next 100 I probably won't have another whale. But it gives us a glimpse. If we could expand at that rate, that means roughly 1.6 million in gross revenue on a particular revenue source for us. And again, it's not interest-based. We don't have those issues. It's generally growing, and it's expandable. So very excited about this. It is a good product. Aaron Storm in the back of the room. Aaron is heading up this effort for us. He is doing a great job. And I haven't, we keep throwing stuff at Aaron to see if he can do it, and he's done it every time. So anyhow, that's merchant services. The next fun thing is we're going to Corona. Yes. We closed escrow on this building about 4 weeks ago, something like that. It's just under 5,000 square feet. It's in Corona. It's called the Corona Point Project. It's where the 91 and the 15 come together on the southeast side. There's a Lowe's there and it's a high-end kind of commercial condo project. And so we own the building, and that's, of our 4 branches, we own 3 of the buildings. And the idea is you own your house, you own your car, you own the building where you do your business. And so we're continuing to do the same. And this philosophy of buying the building that you're occupying is less popular amongst modern banks. So Chase, for example, won't own its buildings. Okay, fine. On the other hand, B of A did that. So think about, for example, the branch on the corner of Euclid and Foothill was put in there in the 1950s, probably at a cost of about $20,000. It's worth more than that today. So at any rate, if Chase were in there, they'd still be paying rent. And so we bought the building. We're in the process of doing architectural work on this now. Hopefully, we can get through the city of Corona and start construction in July, something like that. And by fourth quarter, we hope to have a grand opening, and we'll send everyone an invitation. So that's where the new branch is located. It seems a little strange, like the Star is kind of far away from the other branches. It's because there's a giant lake in the middle, or lake bed, or whatever it is, the Prado Dam. So, and we do have customers in Corona. The challenge is it's difficult to get to us. Down the 91 and the north on the 71, or up the 15 and the 60, it could take 45 minutes to get to one of our branches. So we've had a lot of requests for this. I'm very excited about it. So let's get down to bank performance last year and see how we did. So if we look at total asset growth, total assets are up 12%. Went from roughly 399 million to 446. So a good growth in total assets. Deposits were down a little bit. And a little counterintuitive, but what's happening there is we didn't lose a big customer or something else. It's just the customer who had 100 in his account before now has 95. Okay, fine. They spent some of their money. During the year, we opened 864 accounts, so there was an awful lot of work involved. But average balances are decreasing. Loan growth, similarly, we were down 1% between 22 and 23. This one I have mixed feelings on. I'd like to see a big increase in loans, but the most important thing is loan quality. We don't want to take on loans that are going to be problematic for us. Asset quality at the end of the year, credit losses, charge-offs, loans we couldn't collect were a minus 44,000. What that means is in previous times during the Great Recession, we had charged off some loans, and so they're not on our books anymore, and we continue to get payments. So in that case, we recovered 44,000 that was previously charged off. Loan delinquency at the end of the year, 186,000, one loan for 186. Believe it or not, that's the same guy that was delinquent last year, the year before. He he makes a payment every 4 weeks. The problem is he's 6 weeks late, so he never catches up. Anyway, but the good news is this is it's commercial real estate. It's in South Central Los Angeles. It's not a garden spot, but we are at 11% loan to value. So I think we're going to get paid on that one. The bank has no OREO or other real estate owned. Those are foreclosed properties. We don't have any. I used to refer to it as the ALL, or this is accounting for loan and loss leases, loan and lease losses. Now we call it ACL, or accounting for credit losses. We've got $4.5 million in that account, and that represents roughly 2.5%, which is relatively high. However, as a small bank, I think it's important that we stay well reserved for potential losses in the future. Total revenue was up about 33%, or $5.2 million, so a good year for revenue. Interest expense. This is the challenge for our industry, and as we can see, this chart is going through to 2022. And our deposit base is such, it hasn't been a big deal. In 23, it became a big deal. And as you can see, it increased by $4.5 million, or 568%. And it's not just our bank, but it's all banks that were suffering from that same issue. And if you go back into 22, the average rate being paid on a money market account was about 10 basis points, or 10 1/100%. Today it's closer to 4%. So it's a big change for our industry, and the challenge is deposits can reprice overnight, loans don't reprice as fast. And so you get squeezed. Your cost of funding goes up, but the loan still yields the same. And it is, some folks might have caught Bank of America first quarter earnings in 24, the most recent period, earnings down 20%. So it's a big issue. Non-interest expenses, that's rent and lights and payroll. That was up 8% year over year. That's a little more predictable. We can try to control some of that. And non-interest expenses as a percentage of total assets, uniquely enough, went from 1.95 to 1.88. So as a percentage, it went down. Remember, total assets increased 12%, and so that's what caused that reduction. In terms of earnings, earnings were up 5%, going from $4.7 million to $4.9 on a consolidated basis. And earnings per share, we went from a split adjusted 1.47 or $1.47 per share to $1.54 per share. First quarter, the one that just passed, total assets was up 5%, as we can see, pretty good number. And that's first quarter 24 versus first quarter of 23. Deposits, same thing as we looked at year end, down 5%. Loans, in this case, was up 1.3%, and I'm happy to report that loan demand has increased. So not sure exactly why, but we have got more loan requests than I remember having in a long time. It's really kind of nice. And some good requests, not just a bunch of junk. So anyhow, at the end of the first quarter, we're up 1.3%. Capital was up 11.6 or $4.6 million, so good increase in our total capital base. And our revenue in the first quarter, as compared with the prior year, was up 43%. So good number. 1.9 million. Interest expense, the good news is revenue's up 1.9. The bad news is interest expense up 1.6. So that is taking a lot of the fun out of things. But you can see why I'm so interested in the merchant service area, because it's creating a revenue source that's not interest based. It takes up some of that gap. And non-interest expenses, again, that's rent and lights, that's up 10% this quarter over the same year, last year. A consolidated net profit at the holding company level, 6.4%. And I mentioned liquidity because liquidity, this time last year or March of last year was Silicon Valley's problem, First Republic, Signature Bank, etc. And the issue was over liquidity. Folks got spooked. They started taking out deposits and the bank became illiquid. So in terms of our liquidity, we've got 17% of our liquidity, about $58 million in cash. So that's an easy one to reapply. Means 17% of our deposits could run out the door and we'd be fine. Over and above that, we've got lines of credit available from the Federal Reserve and the Federal Home Loan Bank, totaling about $274 million. So that would satisfy 80% of our depositors. So between cash on hand and credit availability, we could satisfy 80% of our depositors. Total earnings in 24 were up 6.4%. Of course, that's additional cash flow, which helps on liquidity. And the investment portfolio, cash flow is about $2 million a month. So that's additional cash generated that offsets liquidity needs. The loan portfolio, average loan to value ratio, and that's, so how much is a property worth in comparison with how much the debt is? Our average is 45%. So we're in pretty good shape there. And if we look at the average time to reprice, that's important. Earlier we were talking about 30-year fixed rate mortgages. Some of those mortgages that were done at 2.7%, the holder of that mortgage is paying 4% to fund it, getting a negative spread. So in our particular case, our average time to a loan reprice is 29 months. Okay? So we will make a commercial real estate loan. The interest rate will be fixed for 5 years, and then it'll reindex at the end of 5 years, and we'll go on for an additional period of time. So if interest rates change, it allows us to renegotiate at those intervals. And our average time is 29 months. Now 67% of our portfolio, or $121 million, will reprice within 3 years. So good reprice numbers. Credit losses in 23 were a minus 43,000. I talked about that. I expressed it before as 44, but anyway, it's 43.9. And at the end of the first quarter, we had an actual positive credit loss of 19,000. We've got a loan that we had previously charged off. It was a second deed of trust. Borrower was making payments, but he became delinquent on the first, and the first was filing foreclosure, so we advanced to protect the first, and that was that credit loss. We have a plan, and hopefully, Lord willing, that loan will be paid off by July, and we can get out of this deal. And loan delinquency, as I mentioned, at the end of the first quarter, 185,000. I bet you can't guess who one that one is. The same guy who was delinquent at year end and the year before. That's Roger's best friend. It's got this is one of those personalities, he's an acquired taste. And he would tell Roger, I'm going to put it in the night drop, and it's not there. And then, yeah, and then, the month would end, and then on the second or third or fourth day of the new month, he'd make the payment for the prior, so you'd never get him off. But anyway, no bank OREO or bank-owned real estate. In terms of company ownership, and I think that's relevant when we talk about stock. And we have one institutional owner. It's a company called Bank Funds out of Chicago. And that's just like the name would imply. They own banks. And they own less than 10%, and they're a non-active investor. They take the Warren Buffett approach. They buy it, they hold it, they keep it for a long time, and they don't call and beat you up, which is kind of nice. So they'll call and inquire, but they're very polite. So how did I do? I went the wrong way. We've got a stable shareholder base, generally speaking, with about 700 shareholders. We do have a challenge and something I need to work on, and that is when we started our bank 25 years ago and we sold stock. We sold it to a lot of people in the community, that sort of thing. Some of those folks are getting to an age now, and unfortunately many of them are passing. and their children don't have the same experience with the stock as the parents did, and so they're choosing to liquidate and to sell those shares. And so our shareholder base is shrinking slowly as they're passing. And so we are going to have to create a project on this and expose the value of ownership to others, primarily our customers. Those are the best prospects because, well, they bank with us. They might as well make some money on the deal. And we need to get some, I would say, younger shareholders, but broaden the base again. What else? Directors and officers own more than 35% of the outstanding shares. Our bank 401k plan, which is owned by our employees, I think is our second largest shareholder. Where's my second? I'm looking at Trish. Okay, all right. So second largest shareholder, the 401k plan. And last year, in the early spring, when things were starting to get rocky, we were concerned about somebody wanting to sell stock quickly, that sort of thing. So the board approved a resolution to fund a stock repurchase plan. And that's where the money is set aside out of capital to repurchase shares that fall within particular rules. And one of those rules would be a trade below book value, and X and Y, and you authorize the broker to execute on your behalf. That way there's no preference involved. I'm not buying his and not buying hers. And so we approved that whole thing, but then Silicon Valley hit and Republic, etc. And stock buybacks became somewhat controversial, most especially amongst regulators. And so in light of everything going on, we decided, no, this would be better for us to hold the capital and just to continue and work through this kind of scary time. So we have the resolution for the stock repurchase. We just never put it into place. And I think this year it's time for us to do that, put this in place. We had 1 million shares. No, we had 100,000 shares trade a week ago Thursday. 100,000 shares, $1 million, and one shareholder. So at any rate, that is something on the horizon. So this is the part of the meeting that I historically really like, because I show how owning our stock is better than owning the Dow Jones or the S&P 500 or what have you. Unfortunately, this year I don't have that much fun with this. So we started off the year, our bank stock trading price was $10.40. We closed at $10.20, so down 1%. Well, that's not good. Comparatively, the Dow Jones Industrial Average closed this time frame up 20%. So the Dow did better. Now, in my defense, if I go for 2 years, I can say, see, it's better to own our stock than the Dow Jones. If you go out 2 years, actually, we compare favorably, but historically, I've looked at a 1-year horizon. And so, okay, why is that? What's going on? Our stock is trading relatively low at about 80% a book. At the same time, the major industries are hitting new highs. The Dow hit 40,000 not long ago. So why is that? Why the disparity? What's going on? Well, in our case, our last trade, $10.20. That's 85% of book value. Book value for our stock is $12. That means 6 times earnings. So you may be familiar with the term PE, or price earnings ratio, and you'll express the price of that stock in relation to the earnings of the company. So last year we had earnings of $1.54, we saw that. At $10.20, that's 6.6 times, so you just divide the two. And what that means is if you were to buy our stock at $10.20, most recent trade, I'd give you a 15% return on your investment. It's a pretty good rate. By comparison, if we look at the Dow Jones Industrial Average, the average current PE is 35 times. So, okay, That means the average stock listed in the Dow Jones is trading at 35 times last year's earnings. That means a return on that investment of about 2.8%. That's at a time when core inflation is about 4.4%. So you're literally losing money on that investment. Why? I don't know why. There's a self-perpetuating or self-fulfilling kind of thing. If people feel like the stock market's going to the roof, or Bitcoin, or Tesla, or whatever it is, and then they act accordingly, they buy, it drives the behavior that produces the results that they thought it was going to have. The challenge with that is if the underlying fundamentals aren't sound. One day somebody wakes up and says, 2.8%, what am I doing? This is dumb. And there's a tendency to pull out of those stocks, and that's when we see the big drops. So anyhow, that's where we are. Hopefully next year I've got a more cheery chart. In terms of recognition, Finley reports the bank was graded as super premier performing again. This particular plaque is 2021, but it looks just like the 2023, so I liked it. But as long as I confess, it's okay. The bank was recognized by the Chino champion, their Reader's Choice Award for 2023. I'm pleased about that. And Bauer Financial graded the bank 5-star. So good recognition. Looking forward, my projection would be the Federal Reserve will begin a quantitative easing process, which will begin with lowering the short end of the yield curve, probably by about first quarter of 2025. And, I don't have any inside knowledge on that. That's my own speculation. And a lot of things could happen between now and then. The two metrics that they've referenced is unemployment at or about 4% and core CPI at or about 2.5%. The 4% unemployment, we're just about there. The core CPI at 2.5, that's got some work to go. Interest rates may remain elevated for a period of time. That's what I was talking about, the long end of the curve and inflation. If inflation doesn't come down sharply, the long end of the curve will remain higher. And things like mortgage rates may remain elevated for a period. The yield curve is likely to turn to a positive curve, which is good for bankers because we make the difference between the short end and the long end of the curve. And credit availability may remain constrained for a period of time as things readjust. I talked about B of A, for example, posting negative earnings or big reduction in the first quarter. That will result in their pulling back on many things. And world events can change everything. Somebody shoots a missile at something else or shoots down something else or blows up something else, and there was a time not too many weeks ago I thought it was World War III, and fortunately everything calmed down and it didn't turn into World War III. But it's a very volatile world we're in right now. Russia's talked about limited tactical nuclear weapons in Ukraine. That's a big deal. So at any rate, the wrong headline, the wrong thing being shot down can change everything. And in that case, let's just say hypothetically somebody shoots a missile. It is a sensitive thing for us, and it looks like World War III. The Fed will immediately drop the rate, and they'll begin to buy the long end of the curve in order to stimulate the economy, much like they did during the pandemic. So I think the key thing to look at on our stock price is the market always overreacts. They overreact too high inappropriately. They overreact too low inappropriately. So it will overcorrect. And in my opinion, it's overcorrecting now in our stock. Look for good fundamentals. At the end of the day, it's all about fundamentals, and buy on the dips. Generally speaking, don't sell in a loss position. When you do, you lock in the loss. I've learned that the hard way. Oh, man. There was this one stock. I was just killing myself on it, and I sold it, and the next day it went up. What else? Volatility creates opportunity. That is true. So what else? The enhanced yield curve potentially will improve not only our bank but all banks, as you get a positive earnings out of that. New Corona branch this year, Lord willing. Merchant service revenue continues to move up, and in the future, management will begin to focus on efforts to promote our stock. So it's always a little bit dicey when you talk about stock because the Securities and Exchange is very picky on these things. So you can't cross any lines, you can't make any representations, but I think you can make people aware that it's available. With that, questions? Yes, ma'am. How many employees? Where's Gabby? 64? All right. You'd think I'd know that. In my defense, it changes. And this is an interesting time. We've got 3 interns coming during the summer break, and so we get a little bit of a lump there. And with Corona, we got some people being added, but 64. Yes, sir.
So, what if I wanted to buy a few $1,000s worth of shares right now?
Okay.
Done?
Yes.
How many are available?
DANN. No, I'm kidding. Yes. So Michael Natzik at Hilltop Securities in Big Bear is our primary market maker.
So we call him.
Give Mike a call and say, I'd like to buy some shares, and he can tell you the availability. And the conversation would be something like, well, I've got this many shares at this price. I can execute on that immediately. And then I can make some phone calls and see if we can fill the order more. Yeah.
All right.
Yes. That's true. Yes, Hilltop Securities, if you look at the back inside cover of the annual report, Hilltop's contact is in there.
Yeah, I think we're down to about 2 years since you said you're going to stick around for 5 years. So can you talk a little bit more about succession planning and maybe take if there's somebody
What the plan is?
over,
Yeah. I'm thinking you're going to drag me out of here kicking and screaming, and at Bernie's age of 93, something like that.
You're much too young.
Yeah. Yeah.
But people, what is the age now? People's death age and productive age.
And I appreciate that. There are some days, Tuesday.
Yeah, when you were 20.
There were as many days when I was 20, because,
So it's like big deal.
Yeah, but I'm dancing around a serious question, and that is, I don't remember how many years have transpired, but I was standing here and somebody asked me, so Dan, how many more years? And I said 5. And that was a well thought through right on the moment. So I don't have any plans. All right, we'll up for 10. The true answer is I'm having fun at it. And things like this merchant service program is really interesting. This is super complicated. This is like, I don't know, brain surgery times the tax code. And it's all made up. I mean, it doesn't exist in nature. We just make this stuff up and has a language all of its own. So it's very stimulating because of its complexity and the potential. So if I were to retire today, I wouldn't get to see that come to fruition. So I'm interested in that. And then things like Corona. Corona's fun for me. I think it's my 7th branch. I think that's the 7th branch. It seems to be getting harder all the time, so I don't know if I got an 8th branch in me or not. But and it's part of it is the design and the floor plan and then the marketing and the execution and the team building and all that kind of thing. And it's really fun in the beginning. I was mentioning a conversation earlier. Corona has a history of auto racing. It's really kind of fun. And in 1913, 14, and 16, they had an international road race in Corona. It's the circle, that you can see. And they went around the circle. And the idea of auto racing safety at the time was wearing goggles. You see these, they got like a leg hanging out of the thing, and they're driving this big old, it's crazy. And they were reaching speeds of 100 miles an hour on this. You know, centrifugal force kind of throws you out of the galaxy here. And you see these old black and white pictures, there are people standing out there. What could possibly go wrong? But anyway, in 1914, the first prize for winning this race was $11,000. Now keep in mind, in 1914, the average house probably cost $1,000 or something. You know, it's pretty low. So if we use it by today's valuation, 11 houses worth, that was big money. And anyway, so I thought it might be fun in this Corona branch to put a race car in the lobby. Yeah, that was cool. And the Baumans used to have it wasn't a race car, it was an old Model A, I guess, in a bank branch. And I thought, yeah, we could do that, that'd be fun. I don't have enough room. Darn. I can either have a new accounts or a race car. All right, I guess. I thought, could I make a race car new accounts desk? Anyway, but in answer to your question, I'm having fun at it. I'm enjoying it. Who knows? You never know. And there are, the truth is, credit unions, uniquely enough today, are buying banks. And, okay, credit unions want to get into the commercial banking area. And rather than try to build from scratch, they're acquiring some banks that are specializing in commercial lending, commercial banking. And they're paying a lot for these banks. There's something about not paying taxes that can make you sloppy with your money. But anyway, those sorts of things. So you never know what may come up in the future. I'm not anxious to sell to a credit union or to anybody else, but those things happen. And so, anyway, we'll see what happens there. Yes, sir. How are you?
Good. Hey, I have to come every couple of years at least and ask you the same question.
Okay. Is this the pizza question?
Well, the pizza, yes. My 120 slices of pizza I got this year were worth less than 100 slices I got last year.
Yes, yes, yes.
I'm not sure if the dividend, stock dividend is actually returning value. And I think, I think as the board especially, you guys have two jobs. So one is to run the bank correctly, which I think you do fabulously.
Mhm.
And the second one is to return value to shareholders,
Right.
which I don't think we've always done as well.
Mhm.
I was looking at, I said, well, I saw that our shares were down this year, and I said, well, we're looking at some other things. Citizens is up 34%. Bank of America is up 39%. Chase is up 46% the same period. And, they're all selling for PE ratios that are around double what ours is.
Yes.
And the other big difference between them and us is that they all offer dividends.
Mhm.
And so the question I tend to ask each time is this something we're going to look at? Because I think what's happening is as our shareholders do get a little older,
Mhm.
our needs change.
Right.
We need more income generating stocks.
Right.
And, we're not, and most of us are original shareholders, I think, as I look around.
Mhm.
For me, I bought when I'm in my 40s, now I'm in my 60s. And, a growth stock in my 40s was a good idea, but a growth stock with no dividend is not such a great idea now.
Mhm.
And so if I need income, I'm forced to sell shares, which depresses the value of the stock. So I'm going to keep asking this question. Chase is right. We should start doing it.
Yes. Well, Terry, it's a reasonable question. And I think I said at the beginning, ask me hard questions, so I appreciate it. The question is cash dividends versus stock dividends versus selling shares. And those are three different approaches to accomplishing the same thing, and that is a systematic way to convert your asset into cash, to pay the rent or go out to eat or whatever you do. And if you've got a cash dividend paying stock, you're going to get a check in the mail and it's going to be for, I don't know, 10 cents a share or $1 a share, whatever it's going to be something. And okay, I'm happy with that. That's good. Our challenge has been since the beginning for 24 years, is that we continue to be a growing bank. And our current leverage ratio is about 9.5%. That's a comfortable capital leverage ratio. So out of $100 in total assets, 9.5 of those dollars is our capital. Now there's some minimum thresholds you can't get below. With the community bank leverage ratio calculation, I can't get below 9%. But again, we're 9.58, so I'm comfortable. The challenge is our shareholders. We've got some folks that are at a point in their life they'd like to get some cash. And trust me, I'm right there with you. We've also got some other folks that would like to continue to build, either because they don't need the cash flow or they're happy with the yield that they're getting. And so the challenge is, if I make a decision for all of the shareholders and I say I'm going to pay $1 per share, I'm going to decrease our capital, I'm going to limit the growth of the bank, and shareholders are going to get a dividend. Okay? For some, they'll be happy. For some, they'll say, what about a dividend reinvestment plan? Because that's the other side of it. You give a cash dividend, and then the shareholder wants a dividend reinvestment because they want to own more stock. Yeah, I get into this circular process again. The whole idea behind the stock dividend, so in that particular case, for every 100 shares you own, we would give 20 additional shares. Now, this year we decided not to do the stock dividend. And the reason is the stock is trading at a low level. And if we were to do a 20% stock dividend, potentially our market price would go below $10. We don't want to do that. Okay. But the idea behind a stock dividend is, if everybody has 100 shares and we send you 20 more shares, for some of our shareholders, they'll sell those 20 shares, and that's what generates the cash. It comes in a different way, but it still generates cash. For some folks, they accumulate it, and they build up the number of shares. It's fine, it's good. Both are fine, depends on what you need, cash or additional shares. As it relates to Citizen and B of A and others, different banks, very big banks, marketed differently. They're traded on some pretty big exchanges, and there's a lot of attention. Our bank is a boutique bank. Most of the world doesn't even know we're here. And so we don't have as much buying pressure. And I had mentioned earlier in the presentation that one of the objectives for this year, as soon as I get Corona done, will begin to bring some attention of our stock. And I think, honestly, if we were to allow our customers to know that our stock's available, I think a lot of them would be interested in buying some, especially as we go through the fundamentals of the earning of the stock. But at the end of the day, it's really about return on equity. Is the company profitable? Is it stable? Is it reliable? Does it have a good franchise value? And is there a future for it? And if those things are true, the cash flow part can be worked out. You can sell a share or 2 shares or 10 shares or whatever it is, and that'll generate the cash. In our particular case, I want to avoid doing a cash dividend at this time because it would be a small dividend. We might end up paying something like 50 cents a share or 20 cents a share or 32 cents a share. And for a lot of folks, that's not going to move the needle. It's not going to be enough to really do very much. And it's decreased your ownership and your value and our capital and our ability to grow. So it's a long way around. I think the pizza question was, we had done a stock dividend, and Terry said, well, wait a minute, you just took the same pizza and cut more slices. It's still the same size pizza, and that is true. The one difference is we're not selling pizzas, we're selling slices of pizza. And so that's what allowed that to make some sense. So.
People still have to sell part of their ownership in the bank, stock dividend, in order to get money. There's still pressure to sell part of the bank.
Sure, yeah. But whether you're selling a share or whether you're decreasing the capital and getting the cash out of it, the capital is still decreasing. One I impose on everybody in the room, the other one, an individual investor makes that choice.
Yeah, although, of course, as you said, in the dividend reinvestment program, trying to figure out a way that some of us who, want to still stay ownership in the bank, but
Mhm.
really it's not a good fit for our investment objectives in our 60s,
Mhm.
can do that. And if, if there's a 10 cent a share, per quarter dividend, that gives me a 4% return, which is fine. That's what I'm going to get in a money market account or something anyway.
Right.
So I don't know if it's something that that you would be willing to put to a vote of the shareholders to see if really what the sentiment is. But I know for me personally, it would help me to continue to be a long-term supporter of the bank if there were some kind of return that I knew I could count.
Yeah. Well, no, we're not going to vote on it. So, again, the important thing is this something that we impose on all the shareholders, or do we allow the shareholders' discretion to liquidate shares or not liquidate a share? And to do a cash dividend and then go through the logistics and the cost of a DRIP program, and DRIP is an acronym for Dividend Reinvestment Program, that's an accounting nightmare. And we don't have enough trading volume to make it make some sense. And so it becomes very expensive and difficult to put. And again, I'm doing that so that we can send folks checks that a percentage send back to us to repurchase shares. So I think the stock dividend or the liquidation selectively accomplishes that. If a shareholder wants to convert it to cash, they can. And if another one doesn't want to, then he doesn't have to. So, anyway. What else?
I want to just touch on the difference between the 20% share from a tax standpoint as opposed to selling 20% of the shares. If you, after 20% of your shares and you sold them, what's the difference between that and getting your shares?
So, a stock dividend at or above 20% from an accounting perspective is treated as a split. And so we don't have any, there are no tax issues associated with this. The accounting is much simpler and easier, et cetera. And that's why we do the 20% stock dividends. In a cash dividend, of course, you've got a taxable event. You're going to pay taxes on that. I don't know, Tom, what?
That's what I was just, I couldn't remember what the
Yeah.
difference was. It's 20%, there are no taxes on that 20% until you actually use that.
That's correct. Yes, that's part of your basis. So if you had 100 shares before, we did a stock dividend, now you've got 120, it's still at the same basis. Now in that example, instead of your basis being, let's say, $10 a share, it now becomes $8 a share because you own more. But none of that's taxable until you actually liquidate it. Yeah.
But for capital gains purposes, is if you liquidated the 20% shares immediately, would it go to long term or would it have to be short term?
That's a great question. I don't know the answer to that. Honestly, I've never sold one. So, and Melinda's not here. Her son is graduating high school. Otherwise, she's a CPA. That's a good question, and I will get you a good answer to that. How's that?
Based on the original basis, it's long-term. If you've held it for the original stock for a year.
Okay, so the dividend shares would be treated like the basis shares.
Yes, based on your original basis.
We've got an answer. All right. So that would be a long-term capital gain.
If you bought the original shares more than a year ago.
Yeah, assuming, yes, your basis shares are more than a year. Okay. Good. What else?
So you're talking about the merchant services, and you said about 100 customers, and most of those are existing customers. Do you plan on, like, over time, you talked about the example of the value proposition where one customer is saving $2,000 a month. So do you see expanding outside the existing customer base over time, and, maybe converting those customers that you sell merchant services into customers for other bank products?
Yes, yeah. So the merchant service program has got a couple of objectives. Number one, of course, is non-interest income revenue, a revenue enhancement, meaning it's you add it to an existing customer relationship, which broadens it and strengthens it. The other is when you reach out. So when you market bank services, many times you'll talk to, I don't know, somebody, a prospective customer, and you'll say, do you want a deposit account? And no. Do you want a loan? No. Safety deposit box? No. And then you go across, well, what if we could save you money on merchant services? And that's when they offer you a chair and a cup of coffee and they want to talk. Because merchant services for the average small business is a big number. The average little donut shop might spend $3,500, $4,000 a month, depending on volume, on merchant services. So the potential of saving, that's a rent payment for some of these guys. The potential of a savings there is an attractive thing, and it allows us potentially to gain a customer that otherwise didn't have a strong motivation to establish a relationship with Chino Commercial Bank, but because we disperse from the merchant service transactions into a deposit account, they become a bank customer. So it expands the relationship, it allows us to reach out to other non-customers. And then there's a third element to this thing, and that is that ISO program that I had described that we were with the prior bank, TIB. We can offer that to other community banks, just like we got from TIB. And that means we provide services for their customers, and we make a margin in between. Now, in some cases, maybe that small community bank is in Missouri or something. That's not a market we could penetrate, et cetera. And in that particular case, the community bank has the first line of risk, meaning if there is a fraud or a loss of some kind, the community bank would take that first line. So anyway, that's the big picture. And on the merchant services model, it's kind of fascinating. Merchant services as a multiple of revenue trade higher than banks. So anyway, let's see. Any other questions? Anything else? No? All right.